Welcome everyone to the latest edition of the JMI Wealth Monthly Update. Now we're recording this in early September. We have two pretty important events bearing down on us at the moment. The Rugby World Cup, of course, but more importantly from an economic and investment perspective, the New Zealand general election. Now it's over 4 weeks till we see the culmination of both of those. So we will very much be in the eye of the storm when we record the next monthly video. And at the moment, the Rugby World Cup is wide open, and the polls suggest the general election is going to be fairly closely contested as well. Now, financial markets, they're normally pretty well behaved around election time. Generally, the forces driving markets won't change overnight with a change in government. Now, there has been a historical correlation between improving business sentiment and centre-right led governments in New Zealand. And should a centre-right coalition eventuate, we would expect that relationship to reassert itself again. Now, there is, as ever with the MMP process, always the possibility of an inconclusive result and bringing with it all the associated uncertainty. Now, this may unsettle markets, and if that does eventuate, the whole resolution and agreement around forming a new government could take some fairly protracted negotiations. Now, this would probably negatively affect the local market. Now, we'll be in a much better position to comment on all this in early October. At the time of recording right now, support for the incumbent coalition government has fallen, although there is some variation in different polling results, and there is a high level, apparently, of undecided voters. In the background, though, the wheels of commerce do keep turning, and over the last month, listed New Zealand companies have continued to report their results for either the half year or full year through to the end of June 2023. Now, in general, companies have delivered results in line with revenue expectations, with roughly half delivering earnings results in line with market expectations. So there's evidence there of pressure on profit margins. Now, central bankers around the world do seem to have sort of embraced the concept of the hawkish pause. So interest rate hikes are slowing as monetary policy authorities assess the impact of the swift rises we've seen in official cash rates around the world. And I would comment that as wholesale rates have moved higher, so have retail interest rates. For mortgage holders, this has affected household budgets and to varying degrees, household disposable income. But we should always remember that retail deposit rates have also increased. So savers have benefited from those higher term deposit rates. Now, in our domestic market, recent events and data releases have sort of somewhat dampened the expectation for a further 25 basis point hike to the official cash rate. It's currently at 5.5%, but I think it's sort of 50-50 amongst commentators as to whether we'll see that cash rate move to 5.75 at some stage. Now, there are a couple of important economic developments that I should also mention that have been sort of prominent over the last month. Firstly, we've continued to see weakness in the New Zealand dollar. Now, currency levels are affected by many forces. One of the key factors is interest rate relativities between different jurisdictions, but you've also got differences in relative economic performance and trade balance issues. Now, New Zealand is running a large current account deficit, and recently there's been a more general acceptance that US interest rates will remain elevated for some time, and they might even have to move higher. Now, this has led to US dollar strength, and the end result has been the Kiwi dollar falling below 60 cents against the US dollar. Now, secondly, we've seen soft commodity price weakness. This has also been a factor in the weaker New Zealand dollar. Now, August saw a material fall in the prices achieved for whole milk powder in the Fonterra Global Dairy Trade Auctions. Now, this has led to significant declines in the forecast for the farmgate milk price that dairy farmers will receive this coming season. Now, if that eventuates, this will be a considerable headwind for the rural economy over the next 12 months. Now, at the last update, I noted that owning growth assets like shares, particularly offshore shares, that's been a real benefit to portfolio performance so far this year. And it's been really encouraging to see portfolio valuations improving and capital gains coming back into portfolio performance. Now, we continue to hold what we refer to as our long-term strategic asset allocation to offshore shares with no sort of short-term tactical bias. In other words, we have a neutral position. And this is true for most asset classes at the moment, given the uncertainties that sort of abound. We do still, however, have a lower exposure to New Zealand listed property than what would be our long-term strategic position. Now, after what's been a pretty pleasing first half of 2023 for overall portfolio performance, August saw share markets in some cases pulling back, and the local share market has delivered a notably weak result for the month. The other offshore markets, they managed to close out the month with some strength, but generally share markets sort of trod water and took stock over August. And I think investors are now sitting back and assessing the risks ahead of them. Helping you achieve, though, your long-term goals for your investments, that's something that we do every day, and it's something we care greatly about. And as ever, we'd love to talk to you. If you'd like advice or guidance with your investment portfolio, why don't you look us up through the website, through Facebook or LinkedIn or even Instagram, and I look forward to catching up with you next month.